The Walt Disney Company is one growth stock down 52% that I think you're going to regret not buying on the dip. I'm going to explain why in this video, so let's get started. So, first, I wanted to take a look at the Walt Disney Company's revenue over the last decade and highlight a few important things that have happened here. So, first, in around 2019, the Walt Disney Company paid a massive sum to acquire Fox, right? And when it did that, it also acquired all of that segment's revenue. So revenue exploded from, let's say, $55 billion here in 2017, 2018, all the way up near $70 billion. So that's that big jump you see there. That was the result of the acquisition and onboarding all of that company's revenue. Okay. Then you had the big decrease in revenue in the following year, of course, due to the pandemic when the Walt Disney Company had to shut down nearly all of its theme parks, all of its cruise ships, some of its hotels and resorts temporarily, and many of its other businesses that requires bringing people together in person. So all of that needed to be shut down temporarily. That brought Disney's revenues down. Okay. Since then, since economic reopening gained momentum, Disney has recovered higher than it's ever been now, revenue at 82.72 billion. Now it's benefiting from a multitude of factors, including the economic reopening, including pent up demand for travel, including its ability to increase prices as a result of increasing inflation worldwide. And so all of those factors have led to Disney's revenue soaring higher, although the business overall is not back to full strength just yet. So don't get fooled just by looking at Disney's revenue thinking, oh, okay, the business is back to full strength. It's really not. It's really just getting itself closer to being back at full strength, but it's still a ways from being at full strength, and I'm going to discuss why. So look at its operating profit margin, and here you can clearly see that Disney is not back to where it was before the outbreak. Before the outbreak, Disney was regularly generating operating profit margins in or above around 20%. Recently, that fell close to zero and has recovered to about 8%. That's on its way higher. It will take some time before Disney gets its operating profit margin back up near the 20% level, which I expect it will do, namely because two primary reasons. First, the theme park segment overall is already more profitable than it's ever been. That segment, the theme park segment within the overall company, is achieving operating profit margins above 30%. That segment. The segment that's struggling for Disney is the streaming segment. And I shouldn't say struggling, but I will just say that is not mature yet in the harvesting profit stage yet. It is just now completing the rollout of its streaming segment. Management has forecasted that the streaming segment will be profitable in 2024. So about 1 year away from that segment becoming a positive to the company's profit. Up until now, from about 2019 till now, that segment has been a drain on the company. It's been spending billions of dollars rolling out the streaming segment. All the while, it's been losing money on the bottom line, just that segment, right? The company had launched Disney Plus at an introductory price to attract customers. It had to do all this marketing to let everybody know that it has Disney Plus available now. It had to invest in the technology to make sure that the platform is running smoothly. It had to launch in new geographies, so new advertising, marketing partnerships, and all of that with each new market and country it was launching in. It was also canceling contracts it had for third party licensing deals for its content. So that was a hit to its profits. all of that had been collectively hurting Disney's operating profitability while it was rolling out. But starting in 2024, the streaming segment is going to be a positive to the company overall, and that should give a step boost in the company's operating profit margin going forward. Similarly, with Disney's cash flow from operations to sales, you can see it was trending nicely higher, going above 24% in the trailing 12 months before collapsing in the aftermath of the pandemic, in the aftermath of the acquisition of Fox, and now it's down near 6.2%. So this as well, similar to the streaming segment, causing operating profit margin to increase, it's also going to cause cash flow from operations to sales to increase as it increases prices, as it reduces the marketing and content spent to roll out these streaming segment. It can start to be more positive in terms of generating cash flow from operations. Additionally, the continued growth of its theme park segment, as well as, don't underestimate the cruise ships, right? The cruise ships only recently started sailing. That was much later than the reopening of the theme parks. And Disney just brought on board a brand new cruise ship that just started sailing in the summer of 2022. So that's now generating cash flow, whereas previously it was a big cash outflow to get that cruise ship operational. Now that cruise ship is going to start bringing in cash flow as people book trips and as they pay for those bookings. That's all positive cash flow now because the company's already paid for the cruise ship. That's already cash that's left Disney, and now it's going to start bringing cash back in. So I hope the cash flow from operations and the operating profit margin really highlight that Disney's business is not back to full strength, nowhere near back to full strength. It can be easy to get fooled by the revenue figure and think, oh, Disney's back, right? The theme parks are reopened. Everything is back to full strength now, so the whole company should be back to full strength. That's not the case. It takes time to recover from the type of devastation that the pandemic caused the business. Meanwhile, during that same time that it was devastated by the pandemic, it was rolling out this new streaming segment, converting from the linear cable segment that was very lucrative for the company. So it had two big things going on all at the same time, and then add to that the acquisition. So it had a lot of things happening all at once, and so it made it more difficult for it to recover from the devastations of the pandemic. But it's making progress. It's improved operations, and in my opinion, the company could be, when it recovers to full strength, more profitable than it was before the outbreak because of the improvements management has made to the business. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And because of that sell-off, right? The stock is down 52% off its highs from 2021. Because of that sell-off, investors can buy Disney stock at a relatively bargain price, near the cheapest it's been, according to its forward price to earnings ratio at 17.61. So you're getting this stock at a reasonable price with very depressed earnings right now. Its earnings, its profits are depressed, as evidenced by the operating margin, right? The operating margin is just 1/3 where it was before the outbreak. So even if it recovers another third of that, that's a doubling of its operating income from where it is right now. And that still would leave 1/3 left to recover from the level it was before the outbreak. So you've got a company trading at a good valuation in terms of the price to earnings, and you've got a company that's got good earnings prospects going forward. So it's got the potential to recover a lot of those earnings that it lost during the last couple of years due to those macroeconomic factors that should theoretically be just short term. So for that reason, I think Disney stock is one that one growth stock that you might regret not buying on the dip here. All right, so that's all I've got for this video. I hope I've added some value, and I've hand selected some other videos that I did that I think you will enjoy. That's popping up on your screen right now, so please click one of those and I'll see you over there.